Welcome to the Property Corner with myself, Rowan Alexander. On this episode of the Property Corner, we're going to be talking about the differences between a fixed interest rate and a variable interest rate and looking at which of these is better. So recently in the Home Buyers series, I shared some insight into fixing your interest rate or the option of fixing your interest rate. And I got a number of questions from people wanting to know what it entails. And one interesting comment saying, I wish I had fixed my interest rate in 2021 when the interest rate was at its lowest cycle. So that prompted me to do an analysis of if you were purchasing in 2021 when the interest rate was at its lowest cycle, you had the option of fixing for anything between 1 and 6 years. And I wanted to do a calculation for myself to see whether the opinion that I hold about not fixing your interest rate actually held true. And it's interesting because it's now 2 years later, we can have a look at it and we're sort of midway through the period that they would have allowed you to fix. And this could be a metric that we can track not only now, but also over the next 2 to 3 years and come back to this at every point in time. So just share some of my thoughts about fixing an interest rate. With a linked interest rate or a variable interest rate, as the banks would refer to it, that is an interest rate which is linked to the prime lending rate. Prime lending rate is linked to the repo rate, the rate at which the banks, the commercial banks in South Africa, lend money from the Reserve Bank. Your linked interest rate is the interest rate that you'd always hear announced, or the repo rate is the rate that you'd always hear announced when the Monetary Committee sits and they look at inflation and they decide whether they would like to raise or lower the interest rates to help curb inflation or to help stimulate growth in the country. So a linked interest rate, or also referred to as a variable rate, that would fluctuate over time, depending upon economic conditions and outside factors. The Monetary Committee would take an independent view of the economy and they would decide how to manage or target inflation and try and keep inflation within the parameters that are set. I think currently in South Africa, I think it's about between 4 and 6% that they're looking to target. So bear in mind that whenever you see an interest rate rising or being relieved, it is in an attempt to bring the inflation within that bracket through either stimulating economic activity or trying to curb the economic activity. By raising interest rates, people will spend less and will cut back on unnecessary items such as luxury goods, and in that way spend less in the economy. That's ultimately the effect that they are looking to achieve by raising interest rates. In the same way, if they lower interest rates, it makes access to money more affordable and it would encourage spending and thereby economic activity and help boost GDP. So in 2021, we were coming off the back of this worldwide phenomena, the COVID-19, and we were still really facing the effects of that lockdown had on our economy. We were very much at the lowest point of the interest rate cycle, and the government and the Reserve Bank had made some pretty severe cuts to interest rates and other economic relief to try and stimulate economic activity and try and recover from that complete lockdown that we have that devastated our economy. So at the end of 2021, that was probably the period that our interest rates were, or it was the period that our interest rates were virtually at the lowest end of the cycle. And we try to have a look at, if you had the option of fixing the interest rate at that very lowest point, how much interest you would have paid to date if you had fixed it on a number of different options, or if you had kept it linked and how much you would have paid. So the interesting thing and the view that I've always taken is that we always get caught up looking at interest rates, the next announcement. This Thursday gone past, the Monetary Committee just came out, or the Reserve Bank came out and kept the interest rates the same. So they were unchanged. There was a lot of speculation prior to the meeting whether it would be raised by 25 basis points or kept the same. And while I follow that and I try and keep abreast of that, I've also learned to try and take a longer term view rather than just the next meeting. And the way that I do that is looking at the premium that the banks charge to start fixing your interest rate. They've got a wealth of information in terms of economic data, other statistics that they bring into account. And they've got actuaries, sort of trying to predict what's going to happen to interest rates over the short and medium term. And by asking them for a quotation to fix your interest rate, I think this gives good insight into whether interest rates are going to be going upwards or downwards over the short to medium term. It's not a perfect science, and they also get this wrong. But we'll try and have a look at if you were in that position in 2021 today, let's have a look at how that affected you. So 2021, in November 21 was the latest statistics the banks could give us with, or the period that they could give us where they had different fixed options. So on the 19th of November, they offered you a number of different options. You can fix for 12, 24, 36, 48, or 60 months. So anything between 1 and 5 years. That's the time that you can fix on a mortgage loan. It's not like a vehicle that you can fix for its entire loan term. They limit you to 5 years. So at that stage, prime was 7.25%. And the premium or the fee that they charged for fixing over a 12-month period was 87 basis points. So 0.87% additional over the prime or over the rate that you had achieved with your application. For a 24-month period, that cost went up to 1.56% premium loading, over 36 months to 2.24%, and then looking at 48 months, it's gone up to 2.56%, and over 60 months, they add 2.78%. So we don't have to, sort of look. I will add this chart so that you can refer to it. But for now, we can remember anything between just about 0.9% up to 2.8% was the premium that they were adding. So what does that tell us? That tells us that the banks were taking the view that we were really at the lowest point of that interest rate cycle. And it sort of gives us insight into their projection over the next 5 years. They believe that interest rates would rise. I think that was, a fairly safe assumption to make, and I think everybody anticipated that because we had so much relief. It's interesting to see, where we at the moment, because what's that, about 24 months in, they believed we would be at about just under 9%. And we're currently sitting at 11.25, or 11.75, which is quite a way above that. But let's have a look at what that means in rand value. So if you had fixed your interest rate for a 12-month period initially, and then gone over to the linked rate thereafter, you would have paid 133,000 Rand interest per million Rand since the 19th of November to date. Looking at fixing for 24 months, that interest total would have been 144,000 Rand. If you had fixed for 36 months, that interest would have been 155,000 Rand. For 48 months, 161,000 Rand. And for 60 months, 165,000 Rand. So you can see that the longer you had fixed it, the longer you wanted to de-risk it, the higher the premium would have been that you had paid for it, varying from 133,000 Rand all the way up to 165,000 Rand. The interesting thing is if we look at the linked rate, that figure comes back at 134,000 Rand. So in every scenario where you would have linked your interest rate, if we take a snapshot today, the 12 months would have expired. The 24 months is virtually 2 months away from expiring. The 36 months is still a year away and so forth. But you would have been, the only way that you would have beat the system would have been if you had fixed for the initial 12 month and then it was only by 1,000 Rand. The rest of the scenarios have all put you in a position where you have overpaid what you would have paid if you had stayed on a linked interest rate. It's going to be interesting to track this going forward because we are in a period where the interest rates are higher than whatever the effective fixed rate would have been. So from now on, you're going to start recovering. But it's going to be interesting to see. I find it hard to believe that looking at the 36-month and the 48-month option, that you're actually going to be able to recover that premium that you would have paid, because we'll see. Time will tell. But the reason I'm saying that is if we look at the interest rates that the banks are currently offering at a fixed rate, they're only loading between about 0.3 and 0.5%. So that gives us insight that the banks are thinking that we're really at the peak of interest rates, because they're projecting that interest rates are going to be going down and going down quite steeply over the next 3 years. If you're wanting to fix for 3 years currently, you're only having to add about 0.35% to your interest rates. And that's low. So that really shows us that the banks think that the interest rates are going to be dropping off. So it's going to be interesting to see. Following 36 months and 48 months, we'll track those metrics and see, in a year's time, if you were better off or not. Just remember that early on in your loan term, your interest rate or your interest portion of your repayment makes up the largest portion, and your capital, your smallest portion. Over time, that ratio changes, and your interest rate your interest amount becomes less, and your capital amount becomes more. So having the interest saving later on in the loan becomes less and less relevant. The impact of that becomes less and less relevant. So it's always better to have whatever interest saving you could have earlier on in the loan term, because it will have a larger effect. So if you have fixed your interest rate and you're wanting to cancel that fixed rate and go back to a variable rate, there is a way to do that. And you can engage with your financier, the bank, and find out how you would go about doing that. So they are able to offer you the cancellation of the fixed rate, but there would usually be a penalty involved. So some of the banks are currently putting a percentage-based cancellation amount, say 1% of the loan amount. So on R1 million, it would be 10,000 Rand. And then that money is either recovered by paying it up front or adding it to your premiums on the remaining loan term, which then just means you pay interest on it again for another 19 or 15 years or whatever. So I'd rather recommend, if you're wanting to get out of a fixed rate, pay that money up front and get out. But just as a note, you are able to get out of these fixed rates if you would like to opt for the linked or the variable option at a later point in time. It's going to come at a cost, so be sure to weigh up those options closely if you're wanting or you are considering doing that. So looking at these figures, I still believe and hold firm by my view that sticking to the variable interest rate is the best way to approach your home loan. And there may be certain instances or circumstances where people are looking for surety in terms of repayments, and they are willing to pay a premium to have that security. Remember that the security comes at a cost, and that security cost is the rate that the banks add as a premium to offer that security and to de-risk that loan for themselves. If you're in a position where you're looking for interim relief, 12 to 24 to 36 months, where you need surety in your mortgage bond repayments because you simply cannot afford movement in that repayment, then consider fixing that interest rate. It might cost you more money, but it will give you certainty in budgeting. So I would always believe to stick to a linked rate because I don't believe that you can beat the system and the data out there unless something really sort of unprecedented or that couldn't be predicted happens. But then you might as well be gambling. Yeah, so stick to a linked rate unless there are circumstances which dictate that you should rather fix your rate to give you surety in budgeting. But always remember that comes at a cost. So while I've got these figures up, it's been pretty interesting to see that since end of 2021, there's been an interest rate hike every 2 months up until where we are today. So from 2021 at a point of 7.25% up until 11.75% today, there's been an interest rate hike every 2 months. And it's only last week, for the first time, that we've had a bit of a stabilization of the interest rates. And I really believe and hope that we are at the peak of this cycle. All the commentary out there is coming out saying that they do believe we are at the peak of the cycle. So let's hope from here interest rates start going back downwards. So if you've been listening to this on the audio platforms and you'd like to see the charts that I've been referring to, jump over to YouTube and go and look for the video on our YouTube channel, The Property Corner with Rowan Alexander, and you'll find all the graphics on that video.